Welcome to the debate. Imagine trying to send, I don't know, $50 million across the globe.
Okay.
The technology we have now it's phenomenal. The transfer takes exactly 3 seconds to arrive.
Right.
But in those 3 seconds, the digital bridge asset that you use to move the money, it fluctuates in value.
Yeah.
And suddenly you lose $100,000 in transit. Just like that. That is the exact nightmare scenario that keeps, institutional treasurers awake at night.
Oh, absolutely.
So today we are looking at some recent industry reports detailing the rapid, really explosive growth of Ripple's RLUSD. This is a fully regulated one-to-one dollar-backed stablecoin. It's overseen by the New York Department of Financial Services, and it has already accumulated roughly $1.7 billion in circulation.
Yeah, it is a massive shift to the ecosystem. I mean, its emergence really raises this fundamental architectural question for the network it operates on, which is the XRP ledger.
Exactly.
Because if we have this perfectly stable, programmable dollar that institutions clearly want to use, does that make the network's native volatile bridge asset, which is XRP, does it make it obsolete for institutional finance?
Right. Or does this stablecoin act as a catalyst to build a more robust kind of dual rail system?
Yes.
That is the central tension we are exploring today. And based on the data in these reports, my position is that because institutional risk committees prioritize, above all else, absolute zero price volatility, RLUSD is actively displacing XRP as the primary bridge asset for institutional settlement.
Well, I look at that exact same data, and I draw a very different conclusion.
Okay.
My position is that institutions are actually adopting a dual rail approach. They are optimizing RLUSD to handle their stable dollar settlement, sure. But pure XRP on-demand liquidity, or ODL, remains absolutely essential for exotic foreign exchange corridors and, crucially, for securing sovereign infrastructure on the ledger itself.
Right. Well, to really unpack this, I think we need to step inside the mind of a Treasury Risk Committee at a major global financial institution.
Yeah, the big players.
Right. Players on the scale of BlackRock, Deutsche Bank, MasterCard. The core mandate of these committees is strict capital preservation. They're not running proprietary crypto trading desks.
Right, they aren't speculators.
Exactly. They are moving massive corporate flows. And this is where the mechanics of volatility become, frankly, an insurmountable barrier for a native crypto asset.
But even if that volatility only lasts for a few seconds?
Yes, exactly. Because if a corporate treasury is moving $50 million, a 3-second ledger close might sound incredibly fast to a retail user like you or me.
Sure.
But to a risk manager, it introduces a highly quantifiable mark-to-market exposure.
Okay.
If the price of XRP drops just a fraction of a percent in those 3 seconds, the sender delivers less value to the receiver than they promised.
Yeah, I see what you mean.
It's a risk parameter they just simply refuse to tolerate. And this is exactly why RLUSD is gaining such rapid traction. It behaves exactly like the fiat dollars these institutions already hold on their balance sheets.
A dollar in is a dollar out.
Exactly. By utilizing RLUSD, they bypass entirely new asset class approval hurdles, and they completely insulate themselves from price swings.
I understand the Treasury's aversion to volatility. I really do. But we have to ground this in the balance sheet reality of why these institutions are exploring digital assets in the first place.
Okay, go on.
You have to remember the historical friction of cross-border payments. For decades, the global financial system has relied on nostro and vostro accounts.
Right.
If you aren't familiar with the plumbing of international banking, these are essentially pre-funded pools of fiat currency parked in foreign banks.
Right. Just in case someone needs to execute a payment in that local currency.
Exactly. So we're talking about trillions of dollars globally sitting dormant, earning absolutely nothing, just waiting to facilitate a transaction.
It's trapped capital.
It is. It's totally trapped capital. And pure XRP ODL solves this beautifully. It converts your local dollars to XRP, move that value across the ledger in 3 seconds, and instantly converts it to the destination currency on the other side. In specific corridors, like moving money from the US to Mexico or Japan to Southeast Asia, that exact mechanism has historically delivered 40 to 70% cost cuts.
Wow. Yeah.
Simply because banks no longer have to pre-fund those foreign accounts. So institutions aren't abandoning that infrastructure just because a stablecoin arrived.
You think they're keeping both?
They are strategically balancing the two. They use RLUSD, where direct dollar-to-dollar settlement fits perfectly, and they use pure XRP, where fiat-to-fiat liquidity across different currencies is fundamentally required.
I see the logic there, but let's look at how these risk committees are adapting to the availability of RLUSD when they actually have to move value today.
Okay.
Look at the players tokenizing real-world assets right now, entities like BUIDL, Ondo, Arcax. According to the material we're analyzing, they are actively using RLUSD for redemptions, specifically to avoid interacting with a volatile native token.
Right.
There is zero tolerance in institutional finance for what I call slippage theater, because when a massive investor redeems $10 million of a tokenized treasury fund, the exact $10 million must arrive, not a penny less.
Right, of course.
The mechanics of the XRP ledger process stable transactions incredibly smoothly, and because of that, institutions are consciously pivoting away from the native token entirely.
I hear you. But you are focusing heavily on the endpoint preference of the Treasury. And I think that divorces the user experience from the structural network reality.
How so?
Think about global shipping for a moment. Institutions love the standardized shipping container.
Sure.
It has perfectly predictable dimensions, a declared value, it's stable. In our scenario, that shipping container is RLUSD.
Okay, tracking with you.
But a container cannot magically teleport from New York to London. It needs the shipping canal, and it needs the underlying infrastructure to move. You cannot separate the cargo from the canal.
Right.
The XRP ledger has a built-in decentralized exchange, or DEX, and a fundamental mechanism called auto-bridging.
But wait, if a bank is sending RLUSD, why would auto-bridging pull them back into the native asset?
Because the institution doesn't have to manually touch or hold the volatile asset to benefit from it.
Ah, okay.
When a bank drops RLUSD onto the ledger and wants to pull out Mexican pesos on the other side, the protocol's pathfinding algorithm automatically hunts for the absolute cheapest liquid path to make that trade happen.
Right.
Because deep RLUSD liquidity on the XRPL is naturally paired against XRP, the algorithm structurally routes the trade from RLUSD into XRP and out into pesos entirely in the background. The DEX acts as a universal translator, mathematically matching these intersecting order books. So the bank gets the perfect predictability of the stablecoin, but the network itself fundamentally relies on XRP as the underlying settlement backbone to execute that trade efficiently.
I have to challenge you on the implications of that, though.
Go for it.
We have to draw a hard line between a background protocol function and actual economic displacement.
Okay.
If I send you that shipping container, going back to your analogy, I don't need to hold the bunker fuel for the cargo ship on my balance sheet.
Fair point.
Right? I pay a microscopic transaction fee, the ship moves, and I am entirely done with the transaction. Yes, the pathfinding algorithm might touch XRP programmatically in the background for a fraction of a millisecond. But the financial institution is utterly insulated. They are consciously and deliberately pivoting away from sourcing, holding, or managing any XRP inventory.
They don't want the inventory.
Exactly. The bank does not care what happens in the microsecond routing of the DEX. They care that they didn't have to take on the volatility risk.
But your thesis of total displacement relies on a massive assumption.
Which is?
It assumes that RLUSD already possesses deep, ubiquitous liquidity everywhere on the globe. And if you look at the landscape, it simply does not.
Well, not yet.
We can entirely agree that RLUSD is dominating the major dollar corridors, right? US dollar to the euro or dollar to yen.
Sure, the deep pools.
But the most significant frictional costs in global finance sit in exotic and emergent corridors. We're talking about the Philippines, Thailand, Mexico. In these markets, stablecoin order books remain incredibly thin.
So are you arguing that pure ODL is mathematically superior in those specific markets?
Right now, it is an absolute mathematical necessity.
Okay.
Large ODL liquidity providers, entities like SBI Remit, Bitso, Tranglo, they still run pure fiat to XRP to fiat every single day in those regions.
Right.
And here is where the actual mechanics of the native asset become crucial, specifically regarding market impact. If you are listening to this and wondering why a bank can't just use a stablecoin directly in Mexico, it comes down to how deep the pool of available buyers and sellers is.
Break down the math on that for us, because I think that's really important.
Sure. So imagine a remittance provider needs to move $10 million into Southeast Asia.
Okay.
If the price of XRP is 50 cents, you have to move 20 million tokens through a very thin order book to settle that trade.
Because 10 million divided by 50 cents is 20 million tokens. Got it.
Exactly. When you move volume that large, you start eating through the order book.
Right.
You might buy the first million tokens at 50 cents, but then you've exhausted those sellers. The next million cost you 51 cents. The next million costs 52.
Oh, I see.
Yeah, you are walking the price up on the way in, and then you crash the price down on the way out when you sell. You eat massive slippage.
Which completely destroys the efficiency of the transfer.
Exactly. But if the native asset price is higher, say XRP is at $10, that exact same $10 million transfer requires only 1 million tokens.
Right.
The order book depth required to absorb 1 million tokens without moving the market price is far smaller. So a higher native asset price makes the bridge mathematically more capital efficient. You need fewer tokens to move mountains of money, minimizing market impact. So in these exotic corridors, the native assets price dynamics directly dictate the efficiency of the rail.
That's a fascinating breakdown of the mechanics. But it describes a temporary architectural gap as if it were a permanent structural reality.
You think it's just temporary?
Yes, you're asking why a bank would suffer slippage, but my question is, why would an institution take any 3-second volatility risk in an exotic corridor when they can just wait for a stablecoin market maker to set up shop?
Well, because setting up that liquidity takes regulatory approval and massive capital deployment and local fiat. It doesn't happen overnight.
It doesn't happen overnight, I'll grant you that, but financial incentive guarantees that it will happen.
Okay.
We have to look at the why. Why do market makers set up shop anywhere? Because friction equals widespreads.
Right.
And widespreads equal massive profit margins. Stablecoins have historically been incredibly aggressive at chasing these high-friction premiums.
That is true.
An asset like RLUSD that goes from zero to roughly $1.7 billion in circulation so rapidly is not going to stay confined to major currencies.
You think they're expanding immediately?
Market makers are looking at the Philippines and Mexico right now, seeing those wide spreads, and realizing they can make an absolute fortune by providing deep RLUSD to local fiat pools. The exact same treasury logic that governs a giant like Deutsche Bank will ultimately govern regional players like Bitso and Tranglo.
So you really believe the efficiency of a high-price native asset is just a stopgap?
Absolutely. The high-price XRP efficiency argument collapses the moment a stable dollar can be traded directly for the local currency with sufficient depth.
Okay.
The transition might take a few years to fully map the globe, but financial history shows us that efficiency always wins.
Yeah.
Once those stablecoin pools deepen globally, the need to use a volatile asset to bridge exotic currencies completely vanishes. The native token is relegated to nothing more than a background fee-burning network fuel.
I actually think your argument about the native asset's price becoming less relevant as stablecoins expand uncovers a completely different side of this debate.
How so?
If you argue against the need for a high token price, you inadvertently highlight a hidden superpower of the ledger when the native asset's price is low.
Okay, color me intrigued.
This brings us to a really fascinating dynamic in network architecture known as the capital efficiency paradox.
The paradox being that a low price is actually highly beneficial for certain institutional behaviors?
Exactly. Everyone in the crypto ecosystem usually cheers for a rising token price.
Of course.
But for a global bank that is trying to build long-lived, foundational infrastructure, a lower price acts as an incredible discount.
Interesting.
You see, the XRP ledger is not just a payment rail. It is a decentralized, sovereign substrate for financial objects.
Meaning the actual data and credentials living on the chain. You're referring to the reserve requirements to maintain those objects, right?
Yes, exactly. To write state to the ledger, which simply means saving data permanently to the blockchain, the protocol requires locked reserves. Think of the ledger like a highly exclusive digital filing cabinet.
Okay.
To prevent bad actors from spamming the network with billions of empty folders and crashing the system, the network forces you to lock up a deposit of XRP just to open a folder.
Right, an anti-spam measure.
Yes. You have a base reserve to open an account, plus incremental reserves for every single object you create inside it, that includes trust lines, escrows, and crucially, permissioned KYC credentials.
So every single customer credential requires a locked deposit of the native token.
Correct.
So think about a Tier 1 bank that needs to issue 1 million on-ledger credentials so their global customers can legally interact with RLUSD.
Okay. Based on the network's anti-spam rules, they might need to lock up roughly 200,000 XRP.
Right.
If XRP is trading at $10, that is $2 million of dead capital sitting on the bank's balance sheet just to stand up their identity rails.
Which is a huge cost.
Right. But if XRP is trading at 50 cents, it's only a $100,000 outlay. Therefore, a low native asset price allows institutions to acquire native digital infrastructure and build a massive sovereign footprint on clearance.
That is the paradox, then. They need it high for liquidity, but they need it low for infrastructure.
Exactly. This is the absolute essence of the dual-rail synergy. A high price mathematically bridges exotic corridors with less slippage, but a low price allows institutions to accumulate and own foundational global infrastructure for pennies on the dollar.
I mean, it is a clever observation regarding the ledger mechanics. I'll give you that.
Thank you.
But the dollar cost of locking up XRP reserves is, at its core, merely a solvable engineering problem.
You think so?
Yeah, it's not a foundational pillar of an institution's long-term strategy. The ledger architecture already supports concepts like sponsored reserves.
Right.
This is where a third-party infrastructure provider posts the XRP on the bank's behalf. The bank itself never has to touch, hold, or account for the volatile asset.
But relying on a sponsor introduces counterparty reliance. A major bank won't want their core ledger presence reliant on a startup's balance sheet.
Even if they refuse counterparty reliance, banks don't have to put all that data on the chain in the first place.
How do you mean?
They can keep all the heavy KYC and customer identity data completely off-ledger. Let's frame it simply. A bank can choose to encode a massive identity file directly onto a public blockchain, which, as you pointed out, is expensive.
Right.
Or they can keep their customer data in their own private traditional vault and simply stamp a cryptographic settlement hash onto the XRP ledger. A hash is just a tiny digital fingerprint proving the transaction occurred. It takes up virtually no space, meaning the reserve requirement becomes functionally negligible.
I see.
Your capital efficiency paradox is, completely mitigated by intelligent architectural choices. Institutions are not going to stuff full identity registries onto a public chain when a simple hash will suffice.
I understand the appeal of off-ledger solutions. I do. But put yourself in the seat of a massive, multi-trillion-dollar global custodian.
Okay.
They aren't building experiments. They are building financial rails meant to last for the next 50 years.
Sure.
They demand absolute sovereignty over their systems. Why would they accept heavily fragmented off-ledger identity silos when the entire promise of adopting blockchain in the first place is to have a unified, transparent, and immutable state?
Well, for cost savings, as we just discussed.
But they want sovereign control over their ledger footprint. And a low native asset price allows them to achieve that sovereignty efficiently.
Right.
It lets them accumulate, lock, and truly own their network presence without a crushing capital outlay. This is why the dual rail system isn't just theory, it's practice.
You really see them running both.
Absolutely. Institutions optimize RLUSD for massive, risk-averse treasury flows. They utilize pure ODL for exotic routing, and they leverage low-price environments to build sovereign on-chain infrastructure.
It's a compelling architectural vision, balancing the asymmetry of needing a low price for cheap infrastructure accumulation against a high price for deep bridge liquidity.
Yeah.
However, even granting the deep nuance of reserve mechanics and DEX routing, my core position remains steadfast when we zoom out to actual institutional behavior.
Okay.
The settlement instrument of choice has decisively shifted to RLUSD. Whether the native asset is trading at $10 or 10 cents, the economy of value transfer naturally and inevitably trends towards stable, programmable dollars. The traditional financial world runs on the US dollar. RLUSD is simply the technological evolution of that reality, offering the speed of blockchain with absolute zero price risk.
But as we discussed, you cannot technologically separate that programmable dollar from the underlying decentralized exchange and the network fuel it requires to move.
Technologically, perhaps not, but economically, absolutely.
Really?
Yes. Given the choice between a neutral native asset with open market price discovery and a fully regulated stablecoin perfectly pegged to the dollar, risk committees will take the stablecoin every single time.
Right, for the stability.
Exactly. They must insulate their balance sheets. This dynamic permanently relegates the native asset to background network fuel, essential to keep the engine running maybe, but fundamentally obsolete as the primary bridge asset for institutional finance.
I see.
Total displacement is the logical, unavoidable endpoint of risk-averse capital.
Well, my conclusion remains anchored in the structural reality we've explored today. The evidence points to a continuous strategic balancing act, not a single finish line called total displacement.
Okay?
Global banks are highly sophisticated entities. They are not simply throwing the native asset away just because a stablecoin exists.
You don't think they're abandoning it?
Not at all. They are deploying the right tool for the right job inside a unified ecosystem. Yes, they absolutely optimize RLUSD for massive risk-averse treasury settlement.
Right.
But they will continue to utilize pure ODL where exotic corridor friction and market impact still punish thin stablecoin books. The dual-rail approach allows them to navigate regulatory hurdles, fragmented liquidity, and infrastructural costs all simultaneously.
I will concede that through this discussion, we do converge on one undeniable architectural reality.
Which is?
The massive success of a $1.7 billion stablecoin inherently increases the economic density of the XRP ledger.
Oh, absolutely.
Every single RLUSD transfer necessitates native transaction fees, requires baseline trustline reserves, and frequently utilizes the auto-bridging capabilities of the DEX. A stablecoin of this magnitude operating on the ledger is anything but inert.
We are in complete agreement on that fundamental point. The overall network activity is compounding beautifully.
It really is.
Where we remain divergent is on the long-term balance sheet behavior. Whether financial institutions will maintain direct XRP inventory for pure ODL as stablecoin liquidity eventually deepens around the globe.
Right.
You see an inevitable path to total displacement. I see a permanent, evolving dual-rail equilibrium.
Well, for our listeners following this evolution, the true metric of how this plays out isn't going to be found simply by checking a daily token price chart.
No, definitely not.
You have to observe the underlying data, track the on-chain RLUSD volume, and compare it against pure XRP settlement flows. Watch the still opaque split of institutional volume between stablecoin rails and pure ODL, especially in those emerging markets we discussed.
Yes, that's where the friction is.
And crucially, keep an eye on the multi-chain expansion of RLUSD. Because if a programmable dollar can thrive off the XRPL just as easily as it thrives on it, the institutional liquidity map could shift entirely once again.
Exactly. The key takeaway is to refuse the simplistic narratives that attempt to force a false choice before the global liquidity map is fully finished.
Well said.
The ecosystem is much more complex than a simple winner-takes-all scenario.
We started today by talking about moving $50 million across the globe and the absolute nightmare of losing value in a 3-second window.
Yeah.
Right now, global finance is deciding whether they want to lay down millions of miles of rigid, perfectly stable track with RLUSD, or if the system still fundamentally requires a dynamic suspension bridge that can flex when navigating the most difficult, exotic financial terrain.
Right.
Time and the flow of institutional capital will tell us which architecture truly inherits the future.